Why don't you just tell me a little bit about who you are and what you do here at American
Okay.
Financing?
I'm currently the general manager of operations for American Financing. Um, I got brought on in February of 22. Prior to that, I was underwriting for a student loan company, so privatizing student loans. And my career prior to student loans was like credit union banking and mortgage, like an originator, but more on the sales side. And through that process, I had built programs on a smaller scale for other companies for credit improvement and credit repair, that kind of stuff to, help both borrowers achieve their financial dreams or your just whatever goals that they've set, short term, long term, doesn't matter. And then, of course, on the business side, helping to that company to retain more of its customer base instead of just being like, sorry, can't help you. So they found here at American Financing that experience really interesting and brought me on to build out the credit care department. And we, sometimes it was like upwards of 60 borrowers in a month, like giving them the assistance, guiding them through different credit scenarios so that they were able to, close the gap, it was in both purchase and refinances. So get themselves out of debt, which was a lot of accumulation during COVID, even through now, or buy their first homes, get out of a tough situation that they're in now to buy another home. Families expanding and they, need room for their kids, but their credit's not in a good spot. So a lot of that is what we worked on. And then in January, got the opportunity to take over all of operations. I'm over processing, closing, disclosing, and scheduling.
You mentioned processing. What does a processor actually do?
Processors throughout your whole mortgage experience are kind of sprinkled in different areas, and every company does it a little bit differently. I would say that our company is more on the more processor reliant side. So with other places I've worked, whether, brokerages or originators, their processors aren't always the most knowledgeable. They're more kind of like document collectors and paper pushers, just trying to keep the things moving along. Our processors, like, they really know their guidelines. They, are able to double check the conditions from the underwriter to make sure that they're applicable to the loan. They're I would say, like, I'm one of my processors on the purchase side. She's been doing this for 20 years. So she, like, really knows how to navigate pretty much any complex situation. And that gives us a little bit of a leg up here. So, and they typically fall in like once on a purchase transaction, once you have a contract and you're signed off. So you've signed your initial disclosures, or in a refi, once you've, signed your intent to proceed, you've signed your initial disclosures and you're ready to move forward to the next step. That's when the processor picks it up. And they really run with that all the way to closing until the closer takes that and wraps up your deal for you. So they're impressive, to say the least. I mean, being able to close, 500 to 600 units with 19 to 22 people is great. I mean, they're all really knocking it out of the park.
We can close in as little as 10 days. How does that happen practically?
Really just their situation in general. So like if you're going through a conventional loan that is in a high populated area, so that means that your appraisal is going to move quickly, right? If you're more rural, your appraiser may take 7 to 10 days to complete an appraisal, where if you're more in a high populated area where there's a more plethora of appraisers that can look at your property, then they can complete it in 3, 4, 5 days. And we're always pushing on our side with any of the appraisers that we use to complete it as quickly as possible. But it just depends on, the availability. And then, if you're not in one of the northern states that are split out by a million different counties and townships, where tax certs or title takes a little bit longer. So like those, because those are always the two biggest things that play into any transaction, is your appraisal and title. That's what's going to determine the length of everything else. The rest is how fast we and the borrower are able to move. And we move really fast. So if the borrower is ready to go, then we can make it happen. So from a borrower standpoint, applying for the loan and having all of your documentation ready. So that's going to be not just like your pay stubs and your driver's license, but also your 60 days of bank statements, and, any explanations of weird situations you might be in, whether that's financially, divorces, monies owed, judgments that you're aware of that need to be paid, those types of things. The more you have that up front, the faster that we can collect and work through those documents. So, I mean, we just did one, like, we did it in 10 days, 2 weeks. And it was one of our newer processors that were able to accomplish it. And it was just a very clean file, W-2, employed, had their bank statements ready, had all their docs ready, were very responsive to us, which is like, that's the good partnership we're looking for with our borrowers. And we got them to the finish line, and got them their cash out refi to pay off all their debt and get them out of their, current sticky financial situation, and can set them on the road for success.
You can move a lot faster if you have your ducks in a row
Yeah.
as a borrower.
Yeah. So, and really, we don't expect the borrowers to be able to anticipate everything. That's what we're here for. But just, when you talk with your mortgage consultant, you get your initial needs list of documents, making sure that you're providing that. And then just being as forthright as possible with your income situation, your asset situation, if it's a purchase transaction or a rate term refinance, your credit situation, like any of those things. The more information that you give us, the quicker we can identify any potential issues when it comes to agency guidelines and get those documents, clear those conditions, and get through underwriting. Because our goal across the board, all departments, is to get a file that to closing as quickly as possible for the borrower to give them both the best experience and take that next step on their financial journey, as well as from, also to a benefit of the borrower that this is a loan that will perform well and is sellable, that we didn't make a mistake that ended up really putting them in a worse financial position. Because that's the burden us as a lender, is to provide this service, but also to make sure that we're helping you put yourself into a good financial position and not taking advantage of you, not putting you into a higher rate with more costs and, all these other things that go into it. Like, we want this to be a benefit to you as much as possible. And that's what we're looking for. That's what our sales team does every day, is be able to show benefit. And if there's none, we'll tell you there's no benefit. This isn't the right time. Let's revisit this in 6 months.
I think that's one of the things that really sets us apart, is that we're absolutely willing to go places that maybe other lenders aren't when it comes to, one, helping our customers get what they want, but also protecting them from things that they don't necessarily need.
Yeah. Yeah. I mean, we are the subject matter expert, when it comes to any of this. This is what people are looking for when they come to any kind of originator, is help through this process. This is, for most people, the largest and most stressful financial transaction of their lives. So coming to us and having the knowledge base that we do, we can guide them through that. And it doesn't mean it's going to be without frustration, right? Because what you want as a borrower and what we're able to provide it as, an originator, doesn't always line up. And it's trying to find that middle ground of getting you as much as the borrower what you want, without putting you in a worse position, or putting, you into potential foreclosure down the road or other things. Like, we're looking out for that kind of stuff for loan performance, not just for us as a lender, but for the borrower. But we don't want any of them to be in that kind of position. But we do go the extra mile. I mean, we restructure loans. We'll flip you through 3 or 4 different programs to find what works best for you.
Credit care, I think, is amazing because there's a lot of paid programs you can go through that are not as beneficial to try to repair your credit. And we offer it completely for free.
Yeah. I find it, maybe because I built it,
Right.
but,
That could be part of
I
it.
find it like just very special in the way that we do it here. I mean, the paid for services a lot of times are, they're putting you in a worse financial position with the intention on a long term to put you in a better one. So they're telling you you're maxed out on your credit cards, you're doing these things, so just stop paying everything, let it go all to collections, we'll negotiate, we'll get the bill down, we'll pay that off, and then it's going to take you 4, 5, 6 years to build yourself up, where we will find solutions that may not be clear and evident to you. You might have $30,000 of credit card debt, and I just tell you, you need to pay $1,500, and you can pay $1,500 over the next 2 months or 3 months. You tell me what the timeline looks like for that, but we can knock that down just a little bit, and we'll see enough of a swing and an improvement where we can then push you into a cash out refinance and pay off all of your debt. And now you're way in a way better position credit wise, and you're credit advantaged as opposed to disadvantaged, because your score is going to swing up really high. If you go through these other programs, you're going to be dealing with that for years. And unfortunately, as a whole, the industry, not just mortgage, but any financial lender, is not kind to people who are on those lower credit score brackets. And so we have the opportunity to give them more opportunity, right? That's not just their mortgage, but they might want to buy a car next year. Yeah. Now their scores continuing to increase, and they were able to purchase their car, and they have a lower debt load. So,
Well, that's kind of the interesting thing about, we've talked about it before, but the good debt idea, which is a mortgage, can be considered that, because the more you pay that thing on time, the more it expands your ability to, if you need to buy a car or get further credit or refinance down the road or whatever it is. It's a really powerful tool to sort of revolutionize your overall
It's a
of credit.
savings account. I mean, it is. It's a credit-worthy savings account that both improves your borrowing position, of course, as long as you make your on-time payments and take care of the things you're supposed to, and gives you equity that you're paying into, over the life of that life you have that property. But I mean, that is considered from any creditor standpoint, that is going to be your biggest way. So I'm trying to explain this in a way that makes sense. So like the creditors are basically just a giant library with a scale in the center of it. So they're just collecting information from all these different people that you've obtained loans with, and they don't really have any say so. They're just saying, okay, you're telling them they made this payment, you're telling me they made this payment, great. And they're just creating a library of information. And then they're taking all that information and they're weighing it on a scale of good and bad. The good things being low credit card utilization, on-time payments on a mortgage, on-time payments on an installment loan. Bad things being inquiries, substantial inquiries, collections, judgments that may be reporting to your credits, late payments, those types of things, high credit card utilization. And they're weighing those two things against each other. And then that's calculating a score. And each of the bureaus have a different score. And each bureau has like 18 different scores. And the mortgage, mortgage is standardized. So anywhere you go, you should see the same scores. If you pull within like a 14-day window. If you pull outside of that, the inquiries may have dipped your score, or they may have other things you've done, like paying down credit cards, may have improved your score. So you're like, oh, I applied with American Financing and I applied with Rocket, and my scores were different, but you did that in 2 different months. So the reporting tapes are completely different. Your credit reports are night and day. But so mortgage, I would say, is first. On-time payments, those types of things, that's going to improve your score. And then credit cards are not bad. They are, and a lot of times something that we use to help improve anyone's credit score is just by keeping the utilization low. So like oftentimes we're saying, go get a credit card with a $500 limit, but keep your balance at no more than, or no less than $10, but no more than 25. So you have just a little bit of utilization, which is going to be important for your score because it's performing. It's considered now like you're actually using credit, but you're not above 10% or 20% or 30%, which continues to be a higher mark against you, more weight on the negative side.
Right.
Yeah.
Yeah. Yeah, that's so interesting that I think we've had, well, let's just say just in the US, we have a really weird relationship with credit, because we go to college and on day one of college, there's some guy from some bank sitting there trying to give credit cards out to kids. And you get in this thing where, oh, this is free money, but we're never really educated about the power of what that can do for you down the road. And we're talking not just maybe 4 or 5 years, but 20, 30, 40 years. What do you think are there any other misconceptions around credit cards, credit building that
I
you see a
mean,
lot out
credit's
there?
not been around forever. I mean, the score models that we know now have been around since like actively and privately since like the 70s and 80s. And just kind of increased from there, become more efficient as technology improves, AI improves, these types of things. It's infusing them with more data to make more data driven decisions that will impact your score. But with that, generationally, not just but a couple generations back, they had no experience with credit. And then I would say maybe the middle generation in there had bad experiences because it was kind of viewed as they didn't have the guidance, parental guidance of how to work through credit and those types of things. They went ham. And then now, the current, like last 2 generations are being told that like don't open credit cards, they're terrible, and don't use your credit, which unfortunately is not something that is going to be like a long-term survivability plan in this current like economy, because like you need credit, everything is based on a credit score. Credit's not going away and anytime soon. They're actually developing new score models and different ways to look at it, but the information that's provided to them will always be the same. Are you making your payments on time? Are you maxing out your credit cards and spending beyond your means? Or are you managing your finances appropriate? And any transaction, whether it's an auto loan, a mortgage, applying for a credit card, a personal loan, they're weighing your credit report pretty heavily. And then, depending on the size of your loan, whether it's like a mortgage, we'll collect income and all these other documents from you to try to weigh that against your credit report to offset some of the risk factors. But credit still being the primary driver of everything. So I would say, and when working in credit care, one of the biggest misconceptions was that credit cards are bad, and they're not. They just need to be managed appropriately. And a lot of times a credit card is the first step to buying a home. Because you need to establish credit and you need to establish on-time payments and you need to establish good credit management with like low utilization, not maxing out your balances, those types of things. That's going to get you on the map with credit. And then once you have that, it makes that's your first step in the door. And then now we're looking at your income, we're looking at your bank statements for assets and those types of things to then take you to the finish line. But, not having credit sometimes can be difficult. We do have loan programs for borrowers that don't have any established credit scores, but they have a lower approval rating than or as far as like you being able to get approved with on AUS as a borrower than if you had an established credit score. So it can be done. You can buy your first home. Like Colorado specific, Chaffa offers a no FICO loan down payment assistance program, but it's a little bit more of a restricted program than those who have established credit scores. So there's going to be extra layers, and if you don't want to deal with those, as I've said before, open a credit card, spend a little bit on it, get yourself a coffee, pay it down, but not all the way off. A little bit of interest is not going to hurt you when the long-term gain is an improved score.
Right. Yeah, it's interesting because it's another thing that people maybe don't realize is if you have a credit card and you never use it, the institution could close it, and a closed credit card, regardless of the circumstances, is something that will definitely ding you in the credit.
It definitely will ding you. I mean, so institutions typically, if there's no activity, if you've opened a card and have no activity for 12 months, they'll close it. If you had a history of activity but have not used it, sometimes it's 12 to 24 months before they close your account out. The rule of thumb for any borrower is not to close more than one credit card in a given year. So if you're closing multiple cards because you're like, I'm going to clean up my financial, situation and cut all these cards up and close all these accounts out, you're going to put yourself in a pretty rough credit position for a while before you can pull yourself out of that, as opposed to just staggering it out. So, I mean, I tell borrowers probably not have more than 2 credit cards that you're actively using and keeping those, rule of thumb is always 30%. I say below 10%. I see a bigger swing below 10%, but above 1. So a little bit, but not a ton. But rule of thumb is, 29% or below is going to be more of a positive impact than a negative.
We've seen the bigger swings at under
At under 10. Yeah. So like that 5 to 10% mark of credit utilization is that's like the sweet spot.
time period where you see the swing with a month, a couple months.
For establishing credit, you'll see, your initial establishment is going to happen within 30 days of reporting. So you'll start to see credit scores generate. And then about 6 months in, you're going to see your kind of first big swing. And then about 12 months in, you're going to see your next big swing. And that's going to be with keeping your inquiries low, not having a lot of other credit impacting situations, applying for personal loans, those types of things, and opening all this other credit, because it's weighing against your utilization now against your age, your oldest trade line. So your age of credit. So again, starting young is important. Like if you get a credit card at 18 and you manage that well, by the time you're 30, you have 12 years as your oldest trade line on your credit report with good utilization. I mean, that can pop you right in the 800s. But it's all again about the management of your credit. And that's the part that's not taught. And because of people's bad experiences, they just say, don't do it. Don't get credit. Don't touch your credit. And then we end up working with, 25-year-olds, 30-year-olds, 40-year-olds who have zero established credit and are terrified of opening a credit card or whatnot to establish their credit. And it's that our credit care team does a lot of, counseling and that way of just saying, hey, like this, it seems scary, but it's not. And here's what you need to do. Kind of here's the rules of the game. I mean, just sitting and talking with our credit care team, they have a wealth of knowledge and being able to just absorb just a portion of that, whether or not you choose to proceed with the program, whether or not you choose to proceed with the home purchase or the refinance or any of those things, but just taking the opportunity to give us a chance to say, hey, let us help you. Let's work you through this roadmap. And it's that little bit of education can serve you for the rest of your life. And a lot of times having those conversations and just working with those borrowers, even if they're not ready right now, they tend to come back to us, because they remember that we were there for them. And that's, as a company, one of our core tenets is, customer service and trying to, serve our customers and serve the communities that we're present in and marketing in and wanting to pull business from, because that's you all keep our doors open.
For sure. Yeah. It's good for both of us. Yeah.
Right.
So just a couple questions. One more. So we talked about the conventional loan.
Yeah.
Previously, up until when thereabouts, was it just 620?
It was just 620 was a hard cutoff on conventional loans. And that was towards the end of last year, beginning of this year, that had changed. Just guidelines are constantly being reviewed. I do think that the market as a whole has shifted. You know, all of us went through COVID, and a lot of us were impacted more heavily than others. Whether and more often than not, that was like financial strain, right? Work people lost their jobs or had reduced hours, reduced pay, less commissions. If you're in a sales position, whatever it is, and so everyone moved to credit. So we maxed out credit cards and took out personal loans and everything else as a stopgap, and we're still seeing the impacts of that in the market today. And so that has just naturally driven the average credit score of any given borrower down. And the market in general that's applying right now for a mortgage is in that 600, 500, 600 range, right? There still are all these other borrowers out there that have 700s or 800 credit scores, but they're hiding under 2-3% rates, and they're not interested in coming out of that unless they move into a more difficult financial position where they're forced to give that rate up. Right. That's going to be, high debt load, divorces, those types of things is going to push them to say, I'm going to have to give up this rate because of the financial situation I am. And that typically comes with a lower credit score. So, with going through this the last few years, the agencies have recognized some of that and where these borrowers are at. And in order to, be able to have more opportunity for different loan products, they've stripped away some of the requirements, one of which being unconventional, a 620 credit score. So now they're letting their system, their automated underwriting system that we run every loan through, they're letting that make the determination on the risk factors based on your individual profile. So they're considering your income, your assets, and your credit, and putting all of that together and then saying, is this something that is beneficial for the borrower that we can approve on, or are you at 60% debt to income ratio, which is above their, what their cap is. And this getting you into this loan isn't going to improve your credit standing. So they're going to deny it unless we can find a way to have you meet their metrics.
So there's not a hard and fast number like 590 or whatever that we're looking at.
Every lender is going to be a little bit different. Currently, we're lending as low as 490, and that's just some of the restrictions that we have with warehouse lines and other stuff that we're dealing with. So I mean that's what we are, but as like an industry standard, it's just kind of up in the air. Now there are some things that are difficult right now, like for instance, if you're over 80% on a purchase transaction or a rate term refinance, and you have below a 600 credit score, the mortgage insurance companies are having a difficult time keeping up with the change in guidelines and how that's going to impact their pricing. So like there could be some roadblocks along the way right now because this is relatively new, industry wide. So we're all kind of working through it. And, if you're not at a 490 right now, I mean, we've got borrowers who've applied that are at a 460 or a 430 and because of, one thing or another. And I don't tie that against the borrower to say, oh, well, you're bad. Like you're not taking care of yourself. You're not taking care of your finances, because I don't know their situation. Right. None of us do. And we don't want to hold that number against them. We want to say that as an industry, we have to improve your score to a point where we can lend against it. So let us, regardless of what happened, let us help you get to at least 500. And I mean, right now as a pipeline as a whole, 55% of our pipeline is below a 600. So the borrowers we're serving, over half of them are in that 500 credit score range. So we are very comfortable in this and working with credit challenged borrowers.
Yeah, that's great. That's just, it's life-changing for people to be able to do that for them. Yeah. And I think because people think that there are these hard and fast numbers, there's no way I could get approved. Yeah. My income looks great on paper, but my credit's terrible. No one can help me, but we really can, hopefully, you know.
I mean, the worst thing you can do in a mortgage transaction is get in your own way. It never hurts to ask. The worst thing that we're going to say is not right now. We won't even say no. We don't tell anybody no. We just say not right now. This is what we need to work on. And we can change this to a yes, but right now, maybe no. That's the worst that's going to happen. So give us an opportunity to show you what you can do with your finances, how you can get yourself out of debt, how you can buy your first home. And you'll be amazed at what you can qualify for.
Might surprise you.
Yeah,
for sure.
Exactly.
Yeah. All right. Well, thank you for joining us.